most tax efficient or the most tax advantageous way possible. And it's very possible to actually do this. But before we kick it off, or before we get into the meat of the presentation, I would like to start with a market report. And so this report is as of May 19th, 2017. So what happened last week was that there was a rally, but ultimately equities there was a rally at the end of last week, but it was not enough to overcome the midweek tumble. So only the global Dow actually posted a slight gain by last week's end, as opposed to all the other indexes listed. And then, so what happened was that there's some controversy between Russia and the White House. And so investors appeared to move from equities to bonds, with the yields on the 10-year treasuries falling 9 basis points from the previous week, while dropping over 20 points year to date. So ultimately what happened was that, the market went down slightly, no big deal, nothing too significant to worry about. So we ultimately had a slightly down week, but overall the market has still been doing pretty good, don't get me wrong. Overall the Dow Jones is up 5% so far this year. NASDAQ is up 13%. And then you have S&P 500, which is up 6%. You have the Russell 2000, which is slumping this year. It's only up 0.75%. You have the global Dow up 8.71%. And then 10-year treasuries, they're actually in negative. They've been down since compared to last year. So that's really the market. It fell down a little bit. This week we've been doing pretty good, so you'll probably see some positive numbers. But that's really it as far as the market. Nothing really to be concerned about. Nothing to be. It's still doing pretty good. We're still at all-time highs right now, so there's nothing to be concerned about. And so, to get into the meat of the presentation, this is, of course, my favorite topic is building wealth tax-free. So out of all the topics that I'm ever going to talk about, this is actually my favorite one, because I've learned quite a lot of things from the experts, all the top CPAs out there. And then you have Robert Kiyosaki. You have just a bunch of the different experts out there. So in reality, there are plenty of ways to actually build wealth tax-free. There are so many different ways. You just need to work with the right people, and then you need to use the right strategies ultimately. And before making any financial decision, you should always consider the tax implications of that decision. No matter what it is, marriage, going to school, having a child, or even choosing a nursing care facility or something, you should always consider the tax implications. As a matter of fact, you become a tax subject as soon as you come out the womb. And so me personally, so a big reason why I'm giving this presentation today is that my ultimate goal in life is to be able to build wealth tax-free. So I want to essentially be able to build wealth tax-free, and ultimately not have to pay a dime in taxes, especially when it comes to retirement. And so I really want to build wealth tax-free. And so by the time I hit retirement, I don't have to worry about taxes. That would be the last thing on my mind. If I'm on vacation somewhere, I do not want to think about taxes. I want to be thinking about the vacations and not how much I'm paying back to the government. So let's get right into the presentation. So building wealth tax-free. So one way is to ensure that you're saving for retirement the proper way. So what you can do is, first you can utilize a Roth 401k or a Roth IRA. Always keep in mind that you can have both of these accounts at the same time. So you don't necessarily only contribute to one or the other. You can actually contribute to both. And that's what I was doing when I was at my previous company. Always keep in mind that Roth IRA has some certain income limits. Nothing too major until you fall into the six-figure range. But always take advantage of the Roth aspect. And believe it or not, the Roth is, there's been some discussion or some rumors that the Roth is going away. I don't know how likely that is. I don't think it will be likely. But ultimately, be sure to take advantage of the Roth. You still have this year at least to contribute to the Roth. Remember, once the money is in there, there's no way they can take it away. But with the Roth 401k, you have a traditional 401k and then you have a Roth 401k. So with the Roth 401k, what you want to do is make sure you're contributing up to the maximum match allowed. So let's say your company matches you 50% up to 6% of your contributions. So you should be contributing 6% to that Roth IRA account or the Roth 401k account. That way you're maximizing your match. Even if you plan to leave pretty soon, you never know what can happen. Maybe you stay a little longer. If you leave early, you're not really losing anything by contributing to this Roth 401k other than the employer match. Sometimes they have vesting periods, meaning that you have to stay at the company for a certain period of time in order to claim the full amount of the match. So what you want to do is contribute to the Roth 401k up to the maximum allowed or the maximum match allowed. So if they match you 50% up to 6%, you want to make sure that you're contributing 6%. That way you're gaining a lot of benefits. You're not leaving money on the table. Because if you're not taking advantage of the match, you're essentially leaving money on the table. So although I'm not a huge fan of 401ks, you should at a minimum be taking advantage of the match. And so once you've done that, you've done your homework, you've talked to an advisor, they told you that you should max out your Roth 401k. Now it's time to move to the Roth IRA. And so the IRA, of course, is a separate retirement account not offered by your job. This is something you open outside of your job, and you always have access to this as long as you meet the income requirements. And always keep in mind there's a thing known as the backdoor IRA. So you can always have a Roth IRA. If your income is a bit too high, you just need to maneuver things a little bit. And with the backdoor IRA, all you're doing essentially is you're setting up a traditional IRA and a Roth IRA at the same time. You contribute to the traditional IRA. You won't get a tax deduction for that because your income is too high. But what you can do is you can backdoor it, or you can roll it over, roll your traditional into the Roth, and then ultimately you're now able to accumulate money tax-free. And so you've just moved a traditional IRA into a Roth IRA. You can roll over as many times as you want, as much as you want. So all you're doing is shifting accounts. But the benefit of the Roth is that when it comes time to retire, you don't have to pay a dime in taxes on it. And remember, tax rates are fairly low right now compared to what we've seen in the past. And so always make sure you're maxing out your Roth IRA. The maximum allowed is $5,500 for an individual, and then $11,000 if you're a married couple. Always remember that there are over 1,400 financial benefits for traditional married couples than non-married or non-traditional married couples. And so what this does is now you have two Roth accounts that are accumulating money tax-free. And so with this being said, money is growing tax-free, and then when it comes time to retire, you don't have to pay a dime in taxes on it. Just make sure that if you're pulling out, so with a Roth IRA, you can always pull out principal without penalty or taxes because you never got a benefit up front. But if you're pulling out earnings, then you have to make sure that you do it after age 59 and a half. I never recommend pulling out of retirement accounts early. But if you absolutely need to, let's say you're putting down a big down payment on your first home that you're going to turn into a rental property, then go ahead and do it. Pull out the $10,000, which is the maximum allowed, in order to be penalty free. As far as earnings are concerned, remember, principal are always tax free, specifically with the Roth. But if you absolutely need the money, and I mean you absolutely need it, then it would be safe to dip into the Roth versus any other account. So we've talked about two big accounts, two big ways, two big actions that you can take in order to build wealth tax-free. And then the next step is an account that for some reason a lot of people either don't know about it, they don't know the benefits, they don't really understand it. The health savings account. This is probably the best retirement account that you can have. And I say retirement account, it's actually not really a retirement account, but I call it a retirement account because I don't ever use the money that's in the health savings account. So with a health savings account, you can put in the money pre-tax, or you get a tax deduction, $3,400 actually for 2017. If you're a married couple, $6,750. The money grows tax-free, so you can actually put this money into stocks, bonds, mutual funds, whatever it is out there. You can actually invest this health savings account money. And then when it comes time to withdraw it, preferably in retirement, you don't pay a dime in taxes on it if you use it for medical expenses. Now, let's say you want to use it for a vacation. You can always do that. You just have to pay taxes on it, but no penalty after age 65. So the key here is to never touch the money in the account until you retire. And this can be your Medicare supplement, because we all know Social Security is evaporating. And think about what the average person spends on medical expenses. Think about the 9 out of 10 people out there right now who are retired that are not prepared financially. So this can be a nice supplement. The money is going to grow. Imagine if you've been contributing. Let's say you've been contributing $100,000 in there throughout your life, but now it's grown to $1 million, which is very well possible. Now you have $1 million that you can use for medical expenses, which we know can be huge. This can be for prescription drugs, just a bunch of different things. It doesn't have to be you literally going to the hospital. The key with the HSA: do not spend the money in there now. Use it later. Instead, use maybe use cash for your medical expenses, or use a credit card or something like that. You do not want to use the money that's in the health savings account, because it can hurt you financially. And I see this mistake made so many times. You have a medical expense, and I mean, ultimately that is what the HSA was created for, was to use it for medical expenses. But the secret they don't tell you is that this can be treated as a retirement account, and that this money can accumulate tax-free all the way through. Remember, they can't touch this money. This money can grow forever. It can be in there as long as there's money in there. It just keeps growing and growing and growing and growing and catching momentum. And always max it out. $3,400 in 2017 for a single individual, $6,750 for a family. Always make sure that you have a high deductible medical plan, and just continuously contribute. So for somebody that's younger who doesn't need medical expenses, you don't necessarily need to go to the doctor. So you might want to have a high deductible medical plan fueled by a health savings account, but you never use the HSA money until you hit retirement. So that's another way to grow money tax-free, or live a tax-free retirement. And then another thing, talking about retirement, is to contribute to a permanent or cash value life insurance policy. This is another tax-free wealth strategy right here. Popular options include the whole life insurance and the universal life insurance policy, which is actually fairly new. So with these policies, I mean, I've already described how you can utilize this, but to recap, money in these accounts actually accumulates. So if you pay a premium, let's say your premium is $100, let's say you have to make sure you're covering your life insurance component, and you have to make sure you're covering the operating expenses of the account. And so let's say that's $50, but you're contributing $100 a month. And so what you can do is with this $100, or with this extra $50 each month, it's going to be invested into something, whether it's an index fund or something like that. And ultimately, this money just keeps growing and growing and growing and growing and growing. And guess what? You can actually pull out the funds tax-free in the form of a loan against the policy. And your money still accumulates over time. You just have to make sure you're paying interest, you're paying your premiums. And some of these policies, your premiums actually stop after a while because you have so much money in there. Just make sure it doesn't become a MEC or a modified endowment contract, which is a very fancy term. Just make sure that there's enough death benefit to cover your cash value as well, or the IRS will see you as it's not a life insurance contract anymore. And always remember, not only can you grow money tax-free, but your life is ultimately still protected. And so that's one good thing to have. Money is accumulating tax-free. And so you get to just accumulate money, and ultimately when you get into retirement, you can dip into it. I mean, some people are paying themselves $50,000 a year once they get into retirement from their life insurance policy. I mean, $50,000 a year, that's pretty good. I mean, the average American doesn't even live. They don't even live off of that. So for you to make $50,000 a year just from you contributing a little $100 a month into a life insurance policy, that's pretty big. And I talked about the differences between the types of policies, so I'm not going to get too deep into it, but just know that you can build tax-free wealth through life insurance. This is how the wealthy build tax-free wealth. This is one of the ways, at least. And then we'll move into real estate. This is another one of my favorite topics. So the key with real estate, this is for more so for people who are starting out, but this can apply to if you have 20 properties, 30 properties, it doesn't matter. So what you want to do is you buy a 2 or 3 flat with a fairly low down payment. And this is also an OPM or other people's money strategy. So not only is it a tax-free wealth strategy, but it's also an OPM strategy. And so what you do with the loan is you make sure you include the repairs. If, let's say you buy a fix and flip, you buy it and you tell your lender that, hey, I found a contractor who's willing to fix this whole thing up for this amount. Can you please include this as part of my loan? And they'll do that. So they'll give you the loan to fix the property. They'll give you the cash to give to the contractor. He does his thing, and you have your home. And you only probably put down, I know somebody who just put down $1,000 and they got a 3 flat and now they're renting it out. Their tenants are paying off their mortgage for them and they're getting some money on the side. But what you want to do is you live in one unit. You don't have to, but you can live in one unit, acquire tenants for the other units, and then ultimately the tenants will pay off your mortgage. And then once the home appreciates in value, what you can do is you can refinance the property and then pull out the equity tax-free and then use the proceeds or part of the proceeds to acquire another property. And that way you don't ever pay taxes. And remember, the income that you're making from the properties, you're offsetting with depreciation, you're offsetting with different expenses, maybe mortgage interest, property taxes, which I can help you appeal, of course. But these are just the different things, is that you would never end up paying taxes on this if you use it the right way, meaning that your depreciation is going to offset all your income. So your tax return is going to show that you're losing money on this property, which looks scary, but it's a good thing. You know for a fact you made money on this property. You were tracking your cash flow the right way. Or whether you use a management company or Excel or something like that. But ultimately, real estate is one of the easiest ways to build tax-free wealth. So what you can also do, let's say you don't even like this property, it's not generating enough income or something like that. What you can do is you can sell the home tax-free by using what's known as the homeowner's exclusion, or you can use what's also known as a Section 1031 or a like-kind exchange. Fancy term for you using proceeds from one property to acquire another property. And that's all it means. It's nothing too major. Don't be afraid of the word Section 1031. And also, anytime you have a home equity loan or anything, you can use it for whatever. If you want to fund your child's education through a home equity loan, then so be it. You just have to pay interest. I've seen some interest as low as 1%. So that is one way to build tax-free wealth, or is to use it through real estate. It's a very, I wouldn't say it's very easy, but the concept itself is like why haven't I been doing this for a while when I can be acquiring 2, 3, 4 properties and never pay taxes on the income? And then, yeah, so always keep in mind that even though you might be showing income on your financial statements, your tax return might be showing something different, which is good. You want to have high income on your financial statements, but low income on your tax return. That should be your goal. And then another way is through income shifting. And so this is where it gets really, really tricky. So let me explain. So what you can do is you can set up different business entities, whether it be an LLC, an LP, S corporation. You can set up these different entities, and you can have your salary or you can have your money shielded with these entities. For example, let's say you start an LLC, or let's say you start a corporation, and you don't feel like showing that income on your tax return. You can set up a C corporation, have the property in the C corporation's name, and you would never see a dime in income on your personal tax return. So that's one way. I mean, another way is to actually, let's get into the more comprehensive strategies or the more difficult strategies. So did you know that you can actually turn your kids into owners of your companies? And so what I mean by this is you give a certain percentage of ownership to your kids, whether it be through a limited partnership, where you can be a general partner and have 2% ownership, meaning 2% of income is coming to you and 98% is going on your children's tax return. Well, what does this mean is that you're only showing 2% and your kids are showing 98%. They're probably not making money elsewhere versus you, who needs that income tax deduction. And so that's one way, is to shift income to your entities and to your kids. You can even do this through your parents who don't work anymore. And so, but one thing you want to make sure is that we know kids, they're very smart, they're tech savvy, they find out things a lot. Just make sure that there's a legal document or something, or some sort of mutual understanding. Make sure they know that you're using them as a tax deduction, basically. Don't tell them after they turn 18, when they quote unquote become an adult, and now they own 98% of a company. Luckily, if it's a general or a limited partnership, they can't control that company. They can't make operating decisions, because as a general partner, you're the only one that's allowed to run that company. And so that's one way, is to shift your ownership percentages to your children. This is one of it's a very popular wealth transfer or tax-free wealth strategy by a lot of wealthy people. So kids can be useful, in other words. And then another way is through setting up trust funds and then making sure you have good estate planning. So ultimately, money that goes into your beneficiaries are never taxed, essentially. And so let's say you had a life insurance policy, you died, your death benefit is now $1 million. Well, now you just gave your kids or whoever you designate as your beneficiary $1 million tax-free. I mean, can you imagine what you can do with $1 million, that money that's just sitting there? You can turn your Roth IRA, your traditional IRA, all all these different accounts, you can transfer it to your kids tax-free. If you want to be absolutely safe, you set up a trust fund, and you make sure you go through all the legal documents. You might want to talk to an attorney with this. But the trust fund essentially is another way to pass income or shift income tax-free. And then, so what you can do is you can let your retirement accounts grow. Let's say you're a very wealthy person. You don't necessarily need your Roth IRA money or your traditional IRA money. Well, you can just let it sit. Make sure that you take it out, or you strategize around the minimum required distributions, which you can actually roll over some money through a QLAC, which is basically you're rolling over the money into an annuity, and you're deferring that 70 and a half age requirement. So this is a little more complex, something you might want to seek the help of a tax advisor. But just know that the traditional IRA or traditional 401k, there's ways around the taxes. I would just much rather prefer you do a Roth IRA so that you don't have to go that far. But what you can do is you can set up a trust fund, have the income and principal passed to your kids tax-free. You can gift appreciated assets. Maybe you have a home that's appreciated by a lot and you don't necessarily want to pay taxes on it. You gift it to your kids through a trust fund, or maybe you just pass away and then they sell it or something, or they do something with it to benefit. What you can actually do is you can gift appreciated assets to your favorite charities, such as WGHC or something like that. You can actually gift it, and that way you don't ever pay taxes on it. So if you're ever concerned about taxes, you should just gift your assets. You might be losing money, but hey, you're also getting a tax write-off too, so keep that in mind. And then another thing is become an investor. I mean, investors probably have the biggest tax advantages in the world. Significant, favorable tax treatment. I'm personally an investor. I own an investment company, and I invest in different projects, different companies, different things like that. So I get a lot of tax breaks because the government wants me to create jobs for the economy. They want me to put more money into these companies and ultimately stimulate the economy, so they're giving me more tax breaks. And some investment income can actually be shielded by taking advantage of things known as long-term capital gains. This is how it's some of it is very complicated, but some people heard Bill Gates was paying himself $1 salary. Well, because of things like this, where he didn't have to pay taxes, or he didn't have to pay as much taxes because he shielded his income through investments. And now to transition into turning your ordinary income, so your W-2 income, if you're self-employed, just different things, turn that into passive income by turning your small business into a big business, and you no longer being actively involved, because real estate losses can ultimately offset passive income. So if you turn your income, let's say you're no longer actively involved in your business, you've been in the game for 15 years, now you want to train some people to be under your belt, or you want to have them do most of the work while you just train them or you coach them. So now that's more passive income. And so what you can do is you can use your passive real estate losses. Your tax return is more than likely going to show losses, so you use that to offset income. And then you can always have your investment income passed down to your kids. And so that's another way. And a way to do this is you can literally set up an investment account in your kids' names, and then maybe you want to be the one that's reaping the benefits of that income. Well, your kids are going to have a tax return, so you ultimately just take advantage of their low tax rate. And so to conclude, really, there are plenty of ways to build wealth tax-free. I've named a few. There are a bunch of them out there, but these are the most popular ones. I hope you do take advantage of some of this, because always remember that taxes are typically a person's single biggest expense. So it would be in your best interest. People are saying they're living paycheck to paycheck, or every time their money comes in, it goes out. Maybe you might want to evaluate your tax situation and shield your regular income or your W-2 income into investment income or passive income or something like that. And then always seek the help of a tax professional. Seek the help of experts. They might cost money, but these people can save you quite a lot of money. Always seek an attorney when you're setting up your different entities, your different trust funds, your estates, and all those different, you don't want to do all these things by yourself if you're not an expert in these fields. And so just like you would go to the doctor to get a medical checkup, you probably should go to an accountant or to an attorney to handle your legal case. It's the same concept. And so my biggest advice is to always take advantage of these tax-free wealth strategies. And if you ever have any questions, you can always reach out to me, 773-679-7198. Once again, my name is Jeff Badu, and I look forward to continuously talking to you about wealth building strategies. Thank you.
Money Talks with the Abrantia himself, community accountant. I ever say Sikemu Akrachi for no. Jeff, may I say another beautiful segment. This is about what? Investing without what?
Investing without paying taxes or making money without paying taxes.
Are you trying to trick Uncle Sam?
Oh, never.
You can never even do it.
Never.
All right. 98.3 FM Wasukuswauti. It is your voice, your music, your station. For Gajimediani and Debra for the Ghanaian community worldwide. Nana Chewa, Pokwas Yabayama, Ghana Memo. Adiasa wona. Yada sisa wutie nyamishra. Kafui. Yada munyina masi kwesi entry watin nwa. Big ups to you. All right. And yama koswa yaman tema and I made the Ebro community calendar. Most important information about Betoya Pronso. So I wanted to hear any more than come out for group indum diaspora account home. Just say one more akikasi ni said the be boa wa puyechi. Na diaspora account no ebe boa kwan bebre so san say a banking relationship wo ye wo Ghana mra wo puyechi. So Ghana here so this can be abeko sika nyina be ready ama wo ho. And so person to your school fees, medical bills be and our building projects be a we be no. Sad diaspora account here we afa GN banking. Abeko mo year papa one kasa be who all the transactions are echo so ewo account name at your own expense right there at your fingertips at your own convenience. Empty office no abad north side ha.
Hey.
Abba uptown ha. I just unim zaba. Abba. Entina meka just WGAC the first. Yes, aka abba ewo ye huna no here.
Na entina de me ko bia account.
Oh, baby, wa check kra. Mam and ye chono man to. What can is that for Jeff can is that any mam fa no man to home. Brand new office number okay, Dr. Baye mo request amudi to the name na station so confirming said doctor no Ghana for nyina titu na e uptown ha north side ha about 90% of the Ghanaian population which is 50,000 north side ha Chicago. It will be best for you to have an office here for operations. And doctor say obi a entrepreneur, your business guru there or tiasie or the office ni bia be PM wa ha say your office here ya run here the same floor ya ni omo eboss wa here our station building mo so WGS me see there be adwene ho me say ntino doctor who say we benya wa be pege we nchen here nti anya yira kwan kura Kanashi building Wilson and Broadway 3rd floor phone number 773 219 2053 773 219 2053. Me say team mu bi mama 773 219 2053. Oh, New York, Washington, Ohio, California, Kansas, Dallas, Houston, baby, I will be a North America. Hey, na ubetimi afre aye diaspora account ibi. Baby, I will be a ubetimi afre. Now, my boy, they can walk you through it and open your account on your own. Wow, what Chicago house there, bra. Vivasa, Sikana, what they call Ghana, no. I bet you fee no way, no. O my chamedo man, Ephraim. One cassa be hundi a TMO account to mo. But more than a bra. Na, one more MB account in the mouth. Now, one cassa keep an eye on your transactions. Wait, ain't obedient to me from my account stories to be answered. Offer and I see Canada, man, and I'm a call, and I'm a day, and from a mobile phone, and I'm a phone back here, and I brand and say, Missiana, let me draw me Busa Coco and say, if you were or Sikoha, who would Yakas, and I know Busawe, yes, I started tinting when I wouldn't TV that. It's answered diaspora account, Abama. It's bra. na baby account ne be 773-217-2053 773-217-2053 Group Indom GN Bank and the diaspora account office ba o ma be office no enti mo ma mo na moto na womra embe account ne bi na enko wankasa wo mo a yet was the community Canada na Abraham Jumedian Abanawe Emra Aka